Energy stocks surged late last week as the market priced in possible disruption from the conflict between Israel and Iran. This is Sectors Up Close, and we're talking energy. Crude oil markets have calmed a bit this Monday after a jump at the end of last week, but the conflict between Israel and Iran could still cause massive disruption to oil supplies. That comes after energy companies have trailed the wider S&P thus far this year, as investors worried markets were oversupplied. Matt Miskin is co-chief investment strategist at John Hancock Investment Management. Matt, we saw that price jump last week, but should investors be betting that they'll move much higher?
We would temper expectations a bit here after such a big move, but the fundamentals of energy companies are still pretty compelling. They're paying about a 3.5% dividend yield. They have high free cash flow, exceptionally cheap. And they can offer as a hedge to portfolios when there are geopolitical events like this. So it is something we would consider on the value side of the house, and in global investing. Frankly, there's opportunities all over the world. But what we want to do is make sure we're not chasing after such a big move last week. We got to watch oil prices closely. And as you said, the fundamentals, there is more supply coming on market over time. So we think that's going to be a bit of a drag after this normalizes some.
And as you say, the market was concerned about global markets being oversupplied. Crude came into this crisis about 8% down on the year. So does that mean you should hesitate before pricing in a big upside for any energy company?
Right. And it is always supply and demand when it comes to oil. And oil is really what's going to drive energy stocks more broadly. And that's one of these things where it can move with a lot of volatility. You can play these tactical moves where you're trying to sniff out a big jump, and we did see a big jump. It's hard for us to see that kind of 120 level again on WTI or even in the hundreds. We think it could drift up here into the 80s perhaps, but then actually we would trim as it keeps rising, redeploy those assets. But at the end of the day, again, you're in there. If you're in energy stocks, you're really in it for the dividend. That dividend is pretty attractive for a boring part of the market otherwise.
Where in the energy markets are we likely to see most advantage here? Of course, there's been concern that with WTI in the 70s or even slipping down into the 60s, there's just not much advantage for US producers, not much incentive to drill. Could geopolitics change that?
It could, and what you really want to think about is where they are in the production cycle. So if you're in an E&P or exploration and production energy company, that usually has higher beta, meaning it either moves up or down more so with oil. So that's going to be more leverage to, if oil goes up, you want to be kind of that E&P part, or if oil goes down, that's going to be more of a headwind. If you think about the more midstream, which is kind of the pipelines, these are transporting the oil, these have lower beta. So these are not going to see as much upside, but they also predict on the downside, and they offer more dividends. Frankly, we're a bit more of that midstream infrastructure type part of the market is what we like more. A little bit of that upstream part of the market can help in these kind of big moves in oil prices. But we want to be careful that volatility. We would have a little bit of that for the value side of a portfolio, but the midstream, more defensive, higher dividend parts of energy is what we like more today.
How much ability do these US companies have to step in the short term in this kind of disruption, or is this a much longer term bet?
So the rig count is something that often people look at in the United States to get a determination of kind of how much production is coming online or coming offline. And frankly, the rig count is falling. So even though there's been this policy shift to kind of increase production, or if anything, not provide less regulatory headwinds to decrease production. So there is more ability to produce oil, but as you said, these oil prices coming down is kind of crimping that in the United States. It's going to be hard for them to really turn it up to make up that kind of mismatch of oil supply hitting global markets. But if the Middle East can kind of see more, or OPEC Plus in general was already on a path of increasing production, if that can still be on its way here, that should help. But oil prices rising, macroeconomic standpoint, it does weigh on consumption of consumers, because that's another tax in essence to consumers. And then frankly, it can make inflation go up, which makes central banks less willing to provide stimulus. So it has huge cross asset and macro implications here. But what we're trying to do is really just find those good opportunities that we can, and look for in essence, a way to play this macro wise. And we do think it's going to crimp growth a bit if oil prices continue to rise.
How should investors pick and choose energy firms then? Is it, as you said earlier, all about the dividend?
It is, it is going to be this thing where, oil prices are incredibly volatile to begin with. And if you're adding it to a portfolio, you got to time it really well. And what we actually look for is more oversold periods where it's down and then you're going to see this kind of pop in the energy price. That has happened last week. But more the infrastructure related utility almost. It's not going to be a pure utility because that's in the utility bucket, but there's utility companies that have energy sensitivity. That's how we play it. It's more defensive. It actually can reduce your volatility. It's also got that nice dividend. That's where we play it. And then also, if there is any pop in energy, you usually get a little bit of a benefit from that. So that should be enough exposure for portfolios.
That was Matt Miskin of John Hancock Investment Management. Don't forget you can watch more videos on Reuters.com.